Help us understand what has happened here, because the one day we were saying Tito Mboweni brought a budget that the market seemed to like, and then the next day or couple of next days we are now talking about a total reversal of the gains that we saw on the all share index, i.e. the market, the capital markets, and then on the currency as well.
Good afternoon, Godfrey. And I suppose a well-worn adage that no person is an island applies as well to countries. And South Africa, unfortunately, is not an island. And despite the positive budgets that the minister did produce, we obviously suffer from the ramifications of rising U.S. Treasury yields, reaching 1.5% during the week, pulled back slightly to about 1.4%. But nevertheless, the theme from global bond investors is, well, ironically, is somewhat positive, switching out of treasuries and into riskier assets, with the anticipation of stimulus in the US, which will lead to higher GDP growth. And so that move obviously has ramifications for equities with higher discount rates, and with a possible sector rotation out of, as you mentioned, tech stocks, which have done exceptionally well over the past year, into other sectors which may benefit from the speedy COVID or vaccine rollout and recovery in US consumption.
Yeah, but there appears to be quite a bit of disagreement about why this should be happening, because on the one hand, earlier this week with Jerome Powell, the Fed chairman, saying there was nothing to worry about. He's not going to be pulling back any of the money out of the markets, but the market's responding and going in the other direction, as indicated by those higher bond yields you're talking about. Who's right?
It's very difficult to know exactly who will be right. In the short term, as Ben Graham always says, the market is a voting machine, and the long term is a weighing machine. And so we'll have to see. However, I would be hesitant to bet against the power of the Fed and Treasury and ECB and all the collective institutions, at least in the short term. And so the chairman has said that asset purchases in QE will continue. They're not worried about yields reaching 1.5%. They're not worried about inflation reaching 2%. Now, at least, one can assume that support will remain fully in markets, and what we've seen in the bond markets so far, not necessarily a sign of risk off, but perhaps just really asset class switching into riskier assets or moving up the capital structure into other areas which may benefit from a macro recovery. So from that sense, perhaps not all is bad yet, at least.
Can we categorically say that, therefore, the move we've seen in the markets over the past couple of days is not a reflection of what the market feels about South Africa's budget? This is more the external factors that we are talking about.
Indeed. The Rand is hardly ever I suppose, barometer for the South African economy. Being one of the most liquid EM currencies, it's usually a barometer for global EM sentiment and risk-on, risk-off trading. The budget was well received by markets as a whole, and that's largely because of revised 2020 GDP forecasts. So National Treasury revising the decline down to just 7.2%, which obviously has knock-on effects for tax revenue collection, estimating an additional 100 billion, which will be collected, which then obviously has implications for budget deficits, which come down, and ultimately for debt to GDP, which they now estimate will peak at 89%, as opposed to previously 95%, which they stated last year in the medium-term budget policy statement. So all of this is quite positive. It means less borrowing is needed, which leads to less debt overhang, lower budget deficits, and presumably more tax. And that's obviously good for the economy, and slight benefits like the reduction in positive. So it was overall a positive story based on the assumption that public sector wages will hold and that GDP growth trend improves going forward.
Yeah, I was looking a few minutes ago at the private sector credit extension numbers that came in today. They slowed down to 3.3% in January from 3.6% in December. And then on the M3 front, we're talking about money supply also declining 9.2 from 9.5. Relatively small movements. But what do they show together with the other numbers that we saw coming through earlier in the week, Thato? I think we had PPI numbers coming through also today with the trade balance numbers coming through.
Well, it's difficult to read trends on a month-to-month basis as far as money supply and credit extension goes. I think you'd want to look at a slightly longer time series to really get a sense of what exactly are banks doing, which parts of the loan books are being extended, and it's difficult on a month-to-month basis to draw serious conclusions. I suppose that's my opinion. As far as inflation goes, CPI is still at, I think, 3.2%, and PPI is slightly higher, about 3.5%. Yeah. So, I mean, we're at the lower end of the target band, and so I don't think that provides any sense of concern for the bank as far as rates are concerned. The 3.5% repo is likely to be maintained for at least for the short to medium term, unless other factors now come into play. But we have a firm rand. We're below 15, so there's no real risk of inflation being imported in that sense. Yes, the economy will rebound about 3% this year, or 3.5%, but that shouldn't lead to significant inflationary pressures.
Indeed.